The 2008 financial crisis brought to light several critical vulnerabilities in the U.S. financial system, especially the significant risks tied to banks being overleveraged and exposed to excessive amounts of real estate-related securities. These issues led to widespread economic turmoil, and though financial reforms were implemented afterward, significant dangers still linger. According to recent research by Cryptopolitan, the loss exposure of American banks in real estate-related securities has risen to approximately $750 billion in the third quarter of 2024, a figure 7 times higher than the amount banks held in 2008. The bulk of these potential losses is tied to portfolios known as available for sale, AFS, and held to maturity, HTM, both essential to bank profitability. Mortgage-backed securities, MBS, are financial products created when banks bundle together home loans, mortgages, and sell them as securities to investors. Here's how the process generally works. Loan origination. A lender, such as a bank, issues multiple home loans to individuals purchasing or refinancing homes. Bundling of loans. These loans are then pooled together into a package or bundle that forms the basis for a security, securitization. The bundled loans are sold to an entity such as a government-sponsored enterprise, like Fannie Mae or Freddie Mac, or an investment bank. This entity then issues the MBS to investors. Investor profits. Investors purchase shares in the MBS, and their returns are funded by the mortgage payments made by homeowners. When homeowners make monthly payments, the cash flows are distributed to investors as returns on their MBS investments. The appeal of MBS for banks is that they offload mortgage risks while raising capital for further lending. For investors, MBS was attractive as a source of seemingly steady income, especially during times when interest rates were low. In the early 2000s, as the housing market expanded, banks issued an increasing number of high-risk loans, including subprime mortgages. Loans issued to borrowers with poor credit. Lenders relaxed underwriting standards to meet the demand for mortgages and to create more MBS. Investment banks were eager to purchase and bundle these loans into securities, making profits from fees and selling them to investors who were promised high returns. However, as home prices began to fall, the risky, high-interest mortgages started defaulting at alarming rates, significantly impacting the value of MBS. Many banks were over-leveraged in these securities, which were previously deemed low risk due to the seemingly endless housing price appreciation. When prices fell, MBS values plummeted, banks lost billions, and the ripple effects led to a global financial crisis. Parallels to today. Why 2024 is a concern. Fast forward to today, where banks once again find themselves holding large volumes of mortgage-backed securities, this time with around $750 billion in potential loss exposure due to rising interest rates. This risk is particularly concentrated in 2 key types of portfolios, available for sale or AFS, and held to maturity or HTM. AFS assets can be sold before they reach maturity, but are currently facing declining demand, especially for mortgage-backed securities. HTM assets are retained by the bank until they mature. However, high interest rates are devaluing these securities, increasing the bank's exposure to losses if it needs to sell them early. Banks initially purchased these securities when interest rates were low, resulting in high returns as credit was inexpensive. Now, with rates elevated, sales have slowed, and demand for residential mortgage-backed securities has decreased, compounding the potential for losses. In addition, higher financing costs are sharply cutting into banks' profits, creating more exposure to the economic downturn. The risks for regular Americans, especially recent home buyers. If a recession takes hold, recent homeowners are particularly at risk. High interest rates could make refinancing difficult, and if property values fall, homeowners may face negative equity, where the mortgage balance exceeds the home's market value. This could be especially problematic for recent home buyers who financed their purchase at high interest rates, as they might find themselves unable to refinance or sell without taking a loss. For banks, mounting unrealized losses on AFS and HTM portfolios threaten their stability, as evidenced by the collapse of First Republic Bank in 2023. These banks may need to either reduce their portfolios or absorb losses, potentially leading to stricter lending standards and limited access to credit for Americans. Additional pressure from Treasury and corporate bonds. The potential losses aren't confined to mortgage-backed securities alone. Banks are also facing losses from Treasury and corporate bonds, which have similarly been devalued by rising rates. For instance, Bank of America recently reported an $85 billion loss in its bond portfolio. and a $116 billion decrease in its HTM portfolio over the past 3 years. According to Cryptopolitan, 47 of the 1,027 American banks with assets over $1 billion are facing potential liabilities and losses that represent over 50% of their capital equity. Although these losses are unrealized, meaning the banks haven't sold off the assets at a loss, they create significant risk. What the future could hold. The outcome largely depends on the Federal Reserve's actions regarding interest rates. If the Fed opts to hold or reduce rates, analysts believe that banks may be able to recover some of these unrealized losses, possibly by as much as 25%, easing some of the financial strain. However, if rates rise again, the value of these portfolios could continue to decline, creating an even more challenging environment for banks and mortgage holders alike. This uncertainty means that anyone invested in mortgage-backed securities, big bank shares, or who has recently purchased a home should remain cautious and keep a close eye on economic developments. For banks, the coming months could be pivotal, and the possibility of further downturns underscores the need for vigilance among investors and recent homeowners alike.